In this video, I show you in a diminishing returns to capital model where investment should happen globally, meaning where capital should flow globally. Let's start with the following setup. We have two countries, the US and India. For this model, let's assume output in India is 20% of US output, so we can simplify it and assume output in the US is 1 and India is 0.2. So we get output Y is 1 in the US and 0.2 in India. At the same time, let's assume capital in the US is still 1 and capital in India is 4% of US capital, meaning 0.04. Okay? Now that we specified output and capital, we also need to determine what is our production function. Let's assume our production function Y is equal to A times K to the alpha. And for simplicity, let's assume alpha is 0.5. So 1/2. Or we can rewrite it and say A times square root of K. Now, since we know output and we know capital, we can determine A. So that's the first thing we need to do. Let's start with YUS over square root of KUS must be equal to AUS. So this productivity number, let's call A productivity, must be equal to output divided by the square root of capital K. And we can calculate that. Well, we know that output is 1. We know capital is 1, so square root of 1. But square root of 1 is just 1. So we get 1/1 equals 1. So productivity A in the US is just 1. Let's do the same with India. Output in India over the square root of capital in India is equal to productivity in India, but output in India was 0.2. Now we need to calculate the square root of 0.04. Well, 0.2 times 0.2 is equal to 0.04. So we get, if we plug in 0.04 here in the square root, we simply get 1/2. So we find that productivity in the US and productivity in India are the same in this simple setup. Based on this, we can now draw this. The way we draw this is we put capital on the horizontal axis and we will put output on the vertical axis. Since they have the same alpha, which is equal to 1/2, and the same A, they'll be on the same line. So what we will have is only one line, and that is the line for both the US and India. And we will find that India has capital of 0.04 and thus output of 0.2, and the US will have capital equal to 1 and output equal to 1. So the US is way up here. Now, if we look at this graph, we find that the slope here is much steeper than up here. The slope gives us the return on investment, or the return on capital. This means that in India we have a much higher return than in the US. To see this mathematically, we take the derivative of this function with respect to K to get the slope of this line. If you did not have calculus yet, simply trust the formula I put down. Let's call this the marginal product of capital, MPK, in the most general form, this will be equal to alpha times y over k. You can plug in also the numbers for y and k. So if you plug in y here, then you will get a times square root of k. So what you would get is alpha times a times k to the minus 1/2 in our case. If we replace the alpha with the one we have, we get 1/2 times y over k. And now we can calculate MPK for both countries. So MPK for the US will be equal to 1/2 times y over k. Y is 1, k is 1, so it will be equal to 1/2. And MPK India will be 1/2 times, output was 0.2, and capital was 0.04. So this is 5 times 1/2 gives us 5 over 2, which is strictly greater than 1/2. Okay, so we find the return on capital in the US, or marginal product of capital in the US, is much lower than in India, which means I should invest heavily in India. And we can also look at that graphically. We have the marginal product of capital here, we will have capital here, and now the marginal product of capital will look something like this, and we'll have India here at 5 over 2 with 0.04, and we have the US somewhere down here with 1/2 and 1. Okay. So we have marginal product of capital and we have overall output. So investment should be where the highest return is. So capital should flow from the US to India. And in the end, what we will get is, since some capital flows from the US to India, the US capital decreases, the Indian capital increases until we reach some capital level which is equal. So K US is equal to K India, and Y US is equal to Y India. At this point, we will also have MPK US is equal to MPK India, just like capital US is equal to capital India. Okay, so based on this, capital should flow from the US to India. As capital flows from the US to India, India should have a current account deficit. The US should have a current account surplus. If you have a current account surplus, you're a net saver. If you have a current account deficit, you're a net investor. If you are a net investor, you accumulate capital faster because you take some capital from abroad and you have a capital inflow. So we would expect India to have a current account deficit, the US to have a current account surplus in that case. Because the US has a decrease in output, India has an increase in output, the US has a huge incentive to close its economy, because if the US closes the economy, the capital cannot flow to India. While India has a huge incentive to open the economy to capital investments, because then a lot of capital will flow into India. Thank you for watching.